What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode, I'm bringing you another stock market technical analysis update. And real quick, because it was a holiday weekend and I will not be here the remainder of the week, this will be the last update for the week. So before we get into the charts, you know what you gotta do. Please remember to smash that like button and subscribe to the channel to follow along with all of my updates. Now, first up, we have the ticker symbol SPY, which is the SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. All right, so we see that the S&P 500 SPY ETF closed up about 2% for the day, which is showing us that we finally saw our bounce from this falling knife. Now, one day won't set the trend, so we really need to watch it now because we do have a bearish trend from that bullish trend. And we know that the trend reversed from bullish to bearish because we have the 5 EMA crossing below that 13 EMA, and we do have the price action currently closing below the 20 simple moving average. So right now we're watching these moving averages to act as resistance because in the bull market we expect them to act as support. So now that we're trading below the moving averages, we do see that the price action tried to go up into the moving averages and got right about to the 20 simple moving average before getting rejected and closing lower. Now that's not too surprising because remember, we are expecting to see this ABC correction, and wherever we end up finding this bounce, which we now know is the start of today, we will expect to find resistance very quickly and resume that downward trend and ultimately find the bottom at the correction wave of C. So right now we're waiting and we're seeing where the correction wave B is going to end, and I wouldn't be surprised to see the wave B end somewhere around this 0.382 Fibonacci retracement and right around this cluster of moving averages. So we know that we have that downward trend now, and we're waiting to watch where we're going to find resistance above before ultimately going down another leg and finishing that corrective wave. So watch the price action very closely, and now that we're on that bounce, let's just say we got to the bottom of A and we're looking to find where B is going to go. We're going to know that we hit the top of the B wave when we start resuming back down and we see 1 or 2 red days following that pivot top, and we resume back down to see where we're going to go ultimately at the bottom of wave C. Now, because we do have these gaps below us, I'm still giving the highly likelihood that we're going to see the bottom of wave C at least somewhere around this $327 or $325 price range on the SPY ETF. Now, that would close these gaps that we've had going all the way back to the beginning of August, and that is also going to be a critical support level that we want to see if it holds up. So in any event that we do come down and close these gaps, I would expect to see some type of bounce. Now, that bounce could be followed by more downside. However, that could also be the end of our ABC correction and we could resume our upward trend. So right now we have to give the highest likelihood that this is a correction wave ABC that's ultimately going to be a temporary correction before we resume our upward trend. In any event that we don't resume the upward trend, there should be some very bad news or something going on around us in the stock market that's going to tell us to not expect to see that upside move. However, right now, with all things equal, this is just a stock market correction, and we are still expecting to see more downside, which is healthy for the stock market. So remember, the stock market got ahead of itself and went too high too fast and became overbought, and there was a lot of greed in the market. And right now, we're just seeing smart money ringing the register and taking some of those profits for the year. That doesn't mean the smart money won't eventually return to the stock market and start buying back in. And we do see with today's volume, that volume was lower on a green day than we did have on the selling days. So we had higher volume on down days, and now we have lower volume on a green day. So that tells us that that big money and that smart money is not necessarily just flooding back into the market because we dropped for 3 days. Remember, the smart money are the ones selling. So on a day like today, they're going to sell small amounts of positions because they don't want to cause a stock market crash. They want to ease the stock market into their exit, and they want to see that bounce so that they can exit at these higher prices. And then they are going to continue their selling, and that's going to drive wave C and ultimately come down and close these gaps. So hopefully that psychological analysis helps you understand why we do get this ABC bounce during a correction, and that should help you prevent yourself from getting trapped in any bull trap in any event that you are buying at the top of the B wave. You are going to be surprised when it starts heading back down because you thought you were catching it back on the way back up, and you're not. So really, if you're not sure what's going on, you still need to wait for that B wave to bounce and the end of that C wave bottom, and you're still watching these gaps. The best buying opportunity is going to be somewhere around 327 and 325, and then you could always set your stop loss right below support. In any event that we hit support and bounce out and never come back, you know your stop loss could be hiked up in any event that we keep running, and you're still going to lock in those profits. So right now, the patient traders are waiting for more price action to see where the bottom of that C wave is going to be And right now there is a small trade to be made on the B bounce, and we could see it go all the way up and close right around the 13 EMA, which is somewhere around SPY level of $342. Now, like I said before, I don't expect the market to just run up in a V-shaped recovery and come back up to the all-time highs. Now, that is a possibility, but I don't expect that to happen because of the fact that the VIX is elevated and we see a lot of fear in the market right now. When there's a lot of fear in the market, you don't typically go test all-time highs, and that's the number one rule with the VIX is you want to pay attention if there's fear or not. If there's not fear, we could see those all-time highs, so pay attention to the VIX, and if it starts going down, we could see a retest of these all-time highs. But if the VIX stays elevated or continues to rise, we're not likely to see that test of that all-time high, and we're likely to finish out another leg down before heading higher. So right now on the SP 500, we're still trading above the 50 EMA. However, we do have to acknowledge that we have this bearish trend and the reversal of this bullish trend. So right now we're in full defense mode, and we're waiting to see where the bottom of that C wave is going to be on the SP 500. Remember, we have these other Fibonacci retracement levels down here, which are the 0.236 and the 0.382 of that larger cycle. And if we do get down to the 0.382, we're talking of a SPY level of 305. So we could still get this scenario where we do see an ABC that brings us all the way down to here. And we also still do have that gap open below. In any event that we do see significant selling, we're looking all the way down to 286. So right now, we're not trying to call where that bottom's going to be because everything is a possibility in the stock market. If all of a sudden we start seeing a wave of bad news, these lower price targets aren't going to be that out of the question, and they will still be much higher than the March lows, so you will see a lot of selling into those levels. But right now, we're trading with what's in front of us, and we are noticing that we saw a bounce today. So we are expecting to see the top of the wave B soon and further move down to the wave C, which right now we're going to give benefit of the doubt to closing these gaps before ultimately finding some support and maybe seeing another bounce off of these levels. Next up is the Nasdaq 100, and we are looking at the QQQ ETF or the triple Qs, and we see a very similar price action with today's movement on the Qs. So we did get a bounce off the 50 EMA, and we did see the price action closing below the 5 EMA, the 20 simple moving average, and the 13 EMA. So we do have that trend reversal, and we do see that we're holding below these moving averages, which is always going to be a bad sign for the bulls. The bears now look like they have control of this market, and we do see a green day on lower volume with the Nasdaq 100 as well. So remember, we see higher volume on red days and lower volume on green days. That is still a downward trending price action movement, and the indicators are still telling us that there's probably more downside coming. Now, that doesn't mean we can't bounce up and close up a little bit higher tomorrow and then ultimately resume that downtrend afterward and find support before ultimately finding the next wave up and seeing if we're going to continue that bull rally. But right now, we're still fully expecting that ABC correction. So any bounces are going to be opportunities to sell into and look for a better buying opportunity at lower prices. So right now we have the 0.236 Fibonacci. It looks like we did bounce off that level as well as the 50 EMA, which was right around that 270 level. So in any event that we come back down to the 270s, we could draw a support line here and we could wait and see if that's going to act as support again. However, it's likely with the ABC waves that we would blow through that and go to a lower level of support. And in any event that we did blow down through that support, there is another level of support at 264. And then of course, much lower than that, we have the 0.382 Fibonacci retracement at 250. So there's still a lot more downside to the market. And you really want to wait for the confirmation of those bounces. When we get to that bottom of that C wave, we want to see a couple days of green before we start entering a position, and we want to set our stop loss below that bounce. So in any event that it continues down, we get stopped out and we could put our capital back to work at lower prices. So right now it looks like we're still in a very healthy ABC correction on the Nasdaq 100 as well, and we're still waiting to watch where that top of that B wave is going to be before resuming a downward trend. Next up is the Dow Jones Industrial, and we're looking at the DIA ETF, and we see a very similar story of course on the Dow Jones, and all three of these indices are trading very similar right now. We see a downward trend with that 5 EMA confirming a downward trend crossing below the 13, and we are still closing below the 20 simple moving average on the price action. So we do also have two gaps below us on the Dow, so we do have to recognize that is going to be our downside risk. So now that we've bounced, we could see something like this, find resistance at the moving averages of the 20 simple, and then come back down here and close these gaps, or bounce off of this 0.236 Fibonacci retracement. So overall, all three indices look like we do have more downside coming, but we could have another day or two of a bounce before resuming that next leg down. Next up is the VIX, which is our fear indicator. And remember, with the VIX this high, we're not expecting to see tests of the previous all-time highs. So right now the VIX did close down about 8.4% today, which is ultimately in line with the market moving higher today. We want to see the fear go lower on the days the market goes higher, and that's what we did see today. So the correlation is there with the VIX going down as the market goes higher, and that's exactly what we want to see. But we still do have a bullish trend on the VIX with the 5 EMA above the 13, and we're now trading above the 50 EMA. So as long as the VIX has this bullish setup and we're still expecting a stock market correction, I'm going to have to give benefit of the doubt to still seeing a top at the top of that B wave and then another leg down to wave C. Everything in the technicals right now in the stock market is telling us that there's more downside coming. So we have to be defensive and we have to prepare for a situation where this is just a short-term balance before resuming a downward move. So just like we expect to see the market go down in an ABC, I would also expect to see the VIX go up in an ABC. So in any event that the market does start tanking, we would start to see VIX get into the levels of the high 30s and low 40s, and that's when we're really going to start to see volatility. When we get into the VIX levels of the high 30s to the 40s, minus 5 to 6% days are going to be the norm, and it's going to be every single day we're swinging drastically in either direction, and intraday we're going to see drastic price swings as well. So right now I'm still giving benefit of the doubt to more downside coming once we reach the top of this B wave bounce. So let's go ahead and jump into the sectors, and first up is the financials, and we did see that the financials broke out of our consolidation wedge to the downside. So that is going to be a bearish sign, and we are seeing that 5 EMA starting to cross below that 13 EMA as of today's close. Now we did get a doji candle, which tells us we're not really sure what's going to happen tomorrow, but I would have to give benefit of the doubt to a downward trend because it looks like this 5 EMA is getting dangerously close to crossing below, and the price action has now closed below the 20 simple moving average for 2 days in a row. So as you can tell, we're seeing these bearish trends building up, and we're seeing the very early stages of a bearish trend. Now, we aren't going to say we're going to be in a bear market because we still have to see where we go after that stock market correction. But there is without a doubt more downside coming because the correction is not yet over and that smart money still has more selling to do. So we're seeing evidence of that all around in the stock market, and the financial sector is no different. Next up is the industrial sector, and we see a very similar story where we're still closing below and those moving averages are acting as resistance. Now, the industrials did hold up pretty well today, and they did almost close back above these moving averages, but you can see here that they were rejected and that resistance is really holding up strong. Now that goes hand in hand with what I've been saying. These moving averages are going to act as resistance as the trend reverses and we go into a bearish trend after a bullish trend. So just as they were acting as support here, they're now acting as resistance here. And that's only a sign that the trend is reversing. You would expect old support to act as new resistance in any event that you break through a support level. You're now looking at that support level to act as a resistance level. And that's exactly what we're seeing with the industrials here. So it still looks like the industrials could have a short bounce before resuming a downward price action move and ultimately seeing if that correction is going to take us down somewhere around this 50 EMA. Next up is the healthcare sector. And we do see the healthcare sector had a nice bounce today after a 3-day sell-off as well. But again, we see the same exact thing with the trend with the 5 EMA below the 13 and the price action closing below the 5. That's very bearish, and no matter how you look at it, this was just a technical oversold bounce, and there's more likely going to be a lot more downside coming in these sectors. We see that this bounce was on lower volume, so we see a very consistent theme in the stock market today where we did see that technical bounce, but it's mostly just a technical bounce from being oversold and having these 3 big sell-off days, and it's on lower volume. So there's no evidence that that smart money and that big money is jumping back into their positions. And that would be expected because if they're trying to sell, they're not going to be buying after 3 days of selling. They're going to sell more than likely for a couple of weeks, and they're going to do it as they can to exit at higher and higher prices. And you're not going to see them just dumping their positions unless there's some really bad news that comes out, and we've yet to see that. Next up is the US dollar, and we're looking at DXY, and we did see the dollar show a little bit of sign of weakness today, but we do still see that confirmation of that bullish trend. So remember, the 5 EMA is above the 13, and the 5 EMA is acting as support. So with the dollar showing a little bit of weakness, it's not surprising to see the stock market go up because as the dollar weakens, we expect asset prices to inflate. And as the dollar strengthens, we're going to expect to see the stock market continue to correct. So right now, the dollar is also going hand in hand with our theory that as the dollar strengthens, we expect the stock market to continue to correct. And right now, the dollar is showing a strong bullish trend and holding up above support on the 5 EMA. That's extremely bullish. So we expect to see the dollar continue to strengthen, and we expect to see the stock market continue to correct downward. So the dollar has now formed that higher high, and it's too soon to say if it's formed a higher low, but I would expect to see the dollar start entering a bullish trend, at least in the near term, for the month of September. Next up is gold, and we see gold bounce nicely off support and did close back above its 13 EMA but below the 20 simple moving average. So right now we're looking for gold to maybe form sort of a cup and handle and ultimately come up here and attack this previous high and break out into a bull market. It does look like support held up, and you can see this really nice pivot bottom where support was held, and now it looks like gold's ready to bounce off support and start testing those previous highs, and they may act as resistance, and we could get up here and then just ultimately resume downward if the dollar continues to strengthen, or gold could be heading back into a bull market and we're seeing the early stages of it. So right now, if you're a buyer of gold, remember to set your stop loss below support. In any event that it does break down below support, you'll get stopped out before it gets worse. Next up is our FOMO stocks, and first up is Apple. And we do see that Apple had a nice bounce today. However, it seems like it's also just a technical bounce. We have the price action trading below all of the moving averages, and we do have that trend reversal with the moving averages crossing down to the downside. With today's price action, it actually looks like the 13 EMA is also going to cross under the 20 simple moving average, which is another bearish trend. We don't want to see that on a bull market. We want to see the price action closing above these moving averages. And right now, we're looking like Apple is also going to do this ABC correction and then come down here and close these gaps before ultimately finding support and resuming its upward trend. So right now it looks like there's still another week or two of selling coming, and if you're not a disciplined trader, you're better off just doing nothing until we see that bottom in the stock market. If you're a disciplined trader, you're going to love times like this because volatility is high and scalping positions is at its easiest. Next up is Tesla, and Tesla is of course our other FOMO stock, and we see a very similar story with Tesla. Even though we did have a nice technical bounce today, it is still a bearish trend and we're still closing well below the moving averages. So on Tesla, it's going to be the same story. Look for that technical bounce into resistance and then ultimately resuming that downward trend into its C wave bottom before resuming its upward bullish trend. So these moves are still about another week or two away from finding where the bottom of C is going to be. And remember, you don't want to try to catch that falling knife. Let's wait for the bounce and wait for the confirmation that the bottom is in before ultimately resuming our long positions on the stock market. So just a quick update on Bitcoin. We see Bitcoin also holding up on its support level from its previous breakout, and we see Bitcoin doing something very similar as gold. So if you are a buyer of Bitcoin, this could be a good area to add to your position or accumulate a position in Bitcoin. And it does look like Bitcoin is going to hold up on the support level before resuming its upward trend. So jumping back to the SP 500, I would expect to see further bounce at least into this resistance area, and it's either going to close right around this area or it's going to be an intraday test yet again of that 13 and 20 EMA and simple moving average. But I do expect to see that downward move of the C move and close these gaps at a very minimum. Now we could close these gaps and not find support and continue down and find support at a much lower Fibonacci retracement level. And that's why I say do not try to catch a falling knife. If you're trying to call the bottom, you might time it perfectly, or the bottom may be way lower than you would have ever imagined. So a disciplined trader would just wait and watch and wait for that confirmation of that bounce and then just set your stop loss right below where it bounced. In any event that you're wrong, you're mitigating your downside risk. So just a reminder, everybody, this will be the last video of the week. There will be no video updates for tomorrow and Friday. And I will probably try to get an update out to you Sunday night before Monday's open on the stock market. So if these videos help you out, please remember to help me out by smashing that like button. And if you want to follow along on all these technical analysis updates and follow along on our analysis on what's going on in the stock market, remember to smash that subscribe button as well. Thanks for watching, everybody. Have a great weekend, and I will catch up with you next week.